Recovery. Welcome to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about EasyJet is that it has raised a lot of cash. This is Andrew Stotz of the Valuation Master Class. Let's get started. Remember, this video is for learning purposes only. This is not investment advice or a recommendation. EasyJet is the company we're looking at today. It's Europe's second largest low-cost airline, operating in more than 30 countries. The question is EasyJet's cash injection enough to fund a tough recovery? There's three things to know about this company. First, cash injection to avert another takeover attempt. Rival price cutting puts strong pressure on margins. And Onestop solution provides scalable synergies. What are some of the key statistics? Well, first of all, there's 23 analysts covering the company. The company is trading at a price of 730 Great British pounds. I think that's what that is, yeah. And the market sees an upside of 15% as a buy. Price to book is about 1.8 times. I don't look at price to earnings right now because earnings have been negative in the past. And dividend yield is zero. It's been suspended over the past 2 years. Of course, you wouldn't want to issue a dividend when you're raising capital. That's like bringing in money from your shareholders and then paying it back out to them. My estimate is about $6.79 for fair value, which is an upside of 7%. So it's about a hold at this point. So what's the sales of this company? Well, the revenue breakdown is 69% passengers, and then 31% is coming from add-on services. Well, cancellation fees is one of them, holiday packages, etc., baggage, things like that. And the breakdown is Southern Europe, 43%, United Kingdom, 28%, and Northern Europe, 28%. Now, price remains bearish, but volume's not bad. Since the second half of 2021, EasyJet faced a severe decline of 33% in its share price. The 50-day moving average line is far below the 200-day moving average line, which provides a clear bearish signal. So also the RSI, relative strength index, has recently been falling towards the 50% line, which, if it continues, could be a bearish signal. In other words, we've had a little bit of a run up recently, but it seems like it's losing some of its steam. So what's the story? Cash injection to avert another takeover attempt. Let's just look at Europe's three largest low-cost airlines. First, there's Ryanair, which has a market cap of 15 billion Great British pounds. In 2019, they had about 152 million passengers. And EasyJet, which you can see has a market cap of about 4.8 Great British pounds and 97 million passengers in 2019. And then there's Wizz, which has a market cap of 4.6, so right behind EasyJet, and passengers of 39 million. So in other words, they're getting a lot more revenue out of fewer passengers. So the Hungarian low-cost airline Wizz Air submitted a takeover bid, which has been rejected by EasyJet's board. The offer tried to exploit EasyJet's discounted share price. Instead, EasyJet decided in September of 2021 to issue a 1.2 billion British pounds equity rights or equity issue through a rights offering. 93% of shareholders accepted the offer, leading to a 107% increase in paid-up capital. Now, what are the benefits of rights offerings versus public issuance of new shares? In a rights offering, the company offers existing shareholders to purchase additional shares, generally at a large discount to the market price. There's no underwriting fees, and it's a fast way of raising capital. Shareholders can avoid dilution by just exercising their right. Also, rights are oftentimes tradable, so you could sell your right too. The point is that it's probably the most common way to raise capital rather than doing a public issuance, which would dilute existing shareholders. A rights issue means you have the right of first refusal. Now, financial flexibility helps to ride the recovery wave. Here you can see long-term debt as a percent of total assets is now about 40%, which is up significantly in 2021. It's been a loss period. Part of the proceeds are allocated to repay its long-term debt, which is swollen to about 3.8 billion in third quarter. And that's now come down to 1.5 billion, or sorry, it's up from 1.5 billion in first quarter 2020. The enhanced liquidity also allows for flexible expansion of its fleets and securing additional slots. The company's not constrained by capacity to capture the likely rebound in 2022. So if things rebound, this company could catch it. Now, rivals are cutting their prices, and also that's putting margin pressure on. What you can see here is a chart where I'm looking at the number of passengers. EasyJet passengers peaked in 2019 at almost 100 million, 96 million. In 2021, they were down to 20 million passengers, so almost an 80% drop. So basically, returning to its almost 100 million passengers a year requires EasyJet to even reduce prices further, because we can see the revenue per seat falling and prices have been falling. Its closest competitors continue to scale up by competing on prices as well. I mean, if you're fighting in a tough environment and you have capital, you can reduce prices and survive. Now, price pressures make it almost impossible to return to a gross margin of about 36 to 38% that it achieved between 2015 and 2019. It might take up to maybe 5 years to get back to that point, to maybe just 33 to 35. Now, the third story here is Onestop solution provides scalable synergies. Launched in 2019, EasyJet established its digital platform that offers the booking of travel packages, including accommodation. In 2021, it signed 40 new exclusive partnerships with hotels. Being a one-stop solution with attractive deals helps to drive growth. 4 to 5 years from now, this segment could contribute 100 million British pounds of revenue, equaling about 15 to 20% of overall EBIT. Remember, you can scan this QR code to go to the valuationmasterclass.com. You just go to valuationmasterclass.com blog, and you can download this and all of our other case studies for free. Let's talk about the FVMR scorecard that we use. It measures a stock's attractiveness relative to all other companies. Attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. And the scale is 1, best, 10, worst. Well, this company is ranked worst right now. And if we go into detail on fundamentals, it's pretty awful. We can see that right now the company's been suffering heavily. In the past 12 months, operating profits down 67%. It's negative growth there, meaning it's falling. And let's say return on assets is negative 10%, and return on equity is negative 40%. That's a pretty brutal time that it's facing. Recently, I created a short online course explaining my FVMR investing approach. I usually sell it for $97, but for a limited time, I'm offering it for free. Just scan that QR code and check it out. Now, let's talk about the forecast. There's 23 analysts covering the company, and they've got about a 15% upside. 15 analysts issued a buy recommendation as the stock price still trades at a large discount to its pre-pandemic level. 2 analysts expect the company to struggle in its recovery, so they have strong sells. Consensus expects recovery in margin, but it'll be a long way away from 35%. Right now, consensus is seeing that the margin will be about 17% in 2021, 18% in 2022, and then 28% in 2023. In other words, putting a lot of bet on later periods, 2023. Now in 2018, it was all the way up to 35%. So it's a long way to get back. Let's look at the P&L for a moment. Net profit could return positive in 2022 after facing 2 years of losses. But even then, the positive is just 46 million pounds. The bottom line mainly depends on a demand rebound in traveling and no further government restrictions to combat COVID. Let's look at the balance sheet. EasyJet has the flexibility to increase its fleet as much as most orders include a purchase right, but no obligation. There's a large amount of net fixed assets, but also a large amount of cash. If you look on the balance sheet of the company, you can see about 3.5 billion pounds worth of cash and about 4.7 in net fixed assets. That increase in cash came from the rights issue. With the demand recovery, I expect the company to return to higher capacity. Let's look at the liabilities here. The leveraged increased significantly, but was partly offset by the rights issue. What you can see is the paid up capital went from 1176 to 2373, basically a doubling in paid up capital due to the rights issue. So the asset efficiency starts to recover in 2022 and 2023. It's about 50 to 66%. That means that the company would be generating about 53 in revenue for every 100 in assets. Now, a lot of times with airline companies, this asset turnover number is pretty low. So actually 53 and 66 is already pretty good. Now, let's look at some ratios. Declining leverage as part of the rights offering proceeds are used to repay debt. In fact, net debt to equity is down to 0.4. That's pretty low, particularly for an airline. So what about the valuation? What's the potential? What's the long-term share price potential? Could this company's share price massively increase? Let's first look at price. Well, I'd say the potential is weak. It's pursuing a low-cost strategy in a low-cost market. Quantity, well, that's pretty good. You could get a fast rebound of passengers. So there's opportunity there, and particularly over the long term. Cost of goods and services, well, positive surprises in margin are possible, but it's difficult to realize. It's going to take a while to get the gross margin back up. And operating expenses, the past cost-cutting measures are already peaking. So what we can see is pretty weak opportunity there. So EPS growth might appear massive, but mainly it's due to a rebound effect. So do I think that this company has a long-term potential to be up by 5 times, let's say? Probably unlikely based upon earnings. How about price? Well, when a company is making a loss, we generally don't say that there's a PE. We don't say negative 10 times PE. So right now we'll say NA for PE. And PE and EPS growth are really distorted because of so much volatility. So maybe it's better to look at price to book. That's something that we can understand a little bit more. And it's relatively cheap at about 1.8 times price to book. But remember, you've got a lower ROE and there's a lot of risk there. So share price seems to be fair based upon the multiple. So is there a potential for this company to grow massively over the next 5 years or so and the share price to go up by 5 times? Probably not. Let's look at the free cash flow. Well, we can see that it was negative in 2021, but is returning to positive in 2022 and onward. So let's now discuss the valuation estimate. So first of all, I'm a bit more cautious about the demand rebound in the aviation industry. Also, price competition might lead to lower than expected revenue. It could take a long time to recover its margin to pre-pandemic levels. I don't think that it can achieve the gross margin of 37% in the next 5 years like it did before 2019. I'm going to evaluate using the free cash flow to the firm method. We have a cost of equity of 12%, a WACC of 8.3, and a terminal growth rate of about 3%. Reasonable assumptions. So base case, 679, that's an upside of 7%. The bull case is 736 Great British pounds, which is an upside of 16%. And the bear is basically flat. So why don't we review the company's world-class benchmarking scorecard before we wrap it up? We identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth. It's on a scale from 1, which is best, to 10, which is worst. Now, the company basically is ranked at 10, which means it's worst relative to 1,480 large industrial companies worldwide in 2020, as well as in the past 12 months. It's been a tough time. First of all, profitability has collapsed to a 10, and growth was a 10 in 2020 and was a 7 in the past 12 months. So improving a little bit on the growth. That's where I think there is some opportunity in both profitability and growth, but the profitability is not going to come back until the revenue growth really comes back. What are the risks? Well, the key risk is falling behind competitors in capturing the rebound. Price reductions by competitors and intensified competition for airport slots is a risk. Lower than expected demand rebound in the aviation industry is a risk, and adverse regulatory changes in environmental liabilities. So let's wrap it up. Is EasyJet's cash injection enough to fund a tough recovery? Well, the conclusion: price wars determine which low-cost airlines survive. Excessive liquidity through rights offerings might lead to overinvestment. And with a high uncertainty and low upside at best, it's probably a hold for now. So my question to you is EasyJet's cash injection enough to fund a tough recovery? What do you think?